Somebody just slammed the red button. And if you woke up thinking gold and silver only know one direction, today was your rude awakening. I'm talking about the kind of drop that makes your screen feel fake. The kind that makes smart people start asking, wait, was the whole run-up a setup? Because here's what's wild. This didn't look like a normal sell-off. It looked like a coordinated pull, where the floor disappears first and then the explanations show up later. And if you don't understand the mechanics behind a day like this, you're going to do the exact thing the market wants you to do next. Panic at the bottom, chase at the top, and repeat. The hot takes are going to be sloppy, and the emotional energy in this space is about to get weaponized. As I'm recording, gold is off roughly 8% from the highs we just saw, and silver is down something like a quarter in a single hit. Read that again. Silver didn't dip, it didn't pull back, it got punched. And if you're holding anything leveraged, anything on margin, anything tied to short-term price action, you already know why this matters. Now, if you're thinking, okay, that's bad, but maybe it's just one market. No. The more interesting part is what happened across markets at the same time. You can pull up price screens from the US, from Asia, from the big OTC hubs, and the pattern rhymes way too closely. Same direction, same timing, same kind of bounce attempt. That doesn't automatically prove a conspiracy, but it does tell you something important. The pressure wasn't isolated, it was synchronized. And that brings me to the first cliffhanger, because there are two different stories you can tell about a synchronized metal slam. One story is dramatic. A few giant players decided it was time to teach the market a lesson, and they fired a cannon through paper markets. The other story is boring, and that's exactly why people miss it. A chain reaction of leverage, margin, and automated hedging that creates the illusion of one big hand. In a minute, I'm going to lay out both possibilities. But first, you need to understand why this kind of move is almost never about physical metal changing hands in real time. When you see gold drop hard, you don't have truckloads of bars flying out of vaults like a movie scene. What you have is paper, futures, options, swaps, structured products. And all of that paper can hit the market in a burst that overwhelms normal buyers and forces price to print lower, even if the physical market is tight. That's not a moral statement, that's the plumbing. So if you're a long-term holder of physical metal and you're staring at a chart like it betrayed you, remember this. The chart is a reflection of the most leveraged layer of the market. It's not a perfect mirror of long-term scarcity. It's a scoreboard for whoever is most active in the derivatives arena at that moment. Now let's rewind to the setup, because a move like this usually doesn't appear out of nowhere. It shows up suddenly, but the conditions build quietly. One of the classic signals is a surge in futures volume right before the move. Not because volume is evil, but because volume tells you big positions are being established, rolled, hedged, or unwound. And when volume spikes at a key moment, it's often the calm before the shove. Here's the part most people ignore. It's not just volume, it's what happens to open interest around that volume. Open interest is basically the count of outstanding contracts still alive. When open interest rises, it often means new bets are being placed. When it drops, it often means positions are being closed, forced, or taken off. The day before a major slam, you'll often see heavy activity that sets the chessboard. Then the next day, you get the shove that knocks pieces off. Now, I'm going to say something that will annoy both extremes of the debate. If you believe every move is pure free market discovery, you're ignoring the reality of leverage and positioning. If you believe every move is pure manipulation, you're also missing something, because leverage doesn't require a secret meeting to create violent price action. Sometimes the market is simply built like a dry forest, and one spark can look like arson, even if it's just physics. So what could the spark be here? One big candidate is options expiration dynamics. Not the fake mystery version, the real mechanical version. Options are basically conditional bets. When a lot of options are clustered around certain strikes, dealers who sold those options will hedge by buying or selling futures to stay neutral. That hedging can push price toward zones where the dealer's book is safer. If you've ever heard people talk about pinning, that's part of it. When the option cycle flips, those hedges get unwound and price can drop fast in a way that feels like somebody pulled a trap door. Now, add another ingredient, volatility. When volatility explodes, margin requirements can rise. That means traders have to post more cash to hold the same position. If they don't have the cash, they liquidate. Forced selling isn't a theory, it's a mechanical rule. And forced selling doesn't care about your thesis, your charts, or your conviction. It cares about collateral. Right now, this is why big down days often come in stairs. First shove, small bounce, second shove, another bounce attempt, third shove. It's not because the crowd all decided to sell in neat increments. It's because liquidation cascades through different layers of leverage at different times as risk systems kick in. Now, does that mean there's no intentional pressure? Not necessarily. Here's where I challenge a popular narrative. People love the idea that the old system is broken, that the major venues have lost control, that the price is about to go into a clean, unstoppable discovery mode. But if that were fully true, You wouldn't get a global synchronized air pocket that snaps multiple screens in near unison. You'd see more divergence, more regional premiums holding, more friction. And yes, there can still be divergence under the hood. Premiums and delivery terms can behave differently even when paper price moves together. But the point is the paper layer still has serious reach. At the same time, don't fall into the opposite trap of assuming a single villain. Even if coordinated selling happens, markets also have arbitrage systems that keep pricing aligned across regions. If one venue slips, big players buy cheap there and sell elsewhere, and that pulls prices back into line. That's not conspiracy, that's math. So, here's the question. Was this a deliberate takedown, or was it a leverage unwind that looked deliberate? I want you to answer that in the comments because your answer reveals how you're going to behave next. Do you see the market as a machine with rules or a battlefield with actors? The truth is usually a mix, and the mix matters. Now let's talk about the why. Now, because timing is never random, in the weeks leading into a move like this, you often see a cocktail of narrative pressure and positioning pressure. Narrative pressure is the chatter, the confidence, the this time is different energy. Positioning pressure is the actual risk on the books. And lately, the narrative pressure in metals has been intense. You've seen the flood of accounts telling you silver is guaranteed to rip, gold is guaranteed to moon, and anyone who doubts it is either dumb or compromised. That kind of certainty is a smell. Markets don't reward certainty, they punish it. Now, I'm not saying the bull case for metals is dead. I'm saying the path matters. Even in major bull markets, you get brutal shakeouts. In fact, the strongest long-term trends often require the most violent flushes because leverage has to get burned off before the move can continue. And that brings me to another cliffhanger. The next move from here will tell you whether this is a reset inside a bigger uptrend or a change in regime. But you can't know that by staring at one red candle. You need a checklist first. How fast do we see stabilization after the drop? Not an emotional bounce. Stabilization. That means price stops making new lows. Volume cools down and the market stops reacting like it's under forced liquidation. Second, what happens to the futures curve? When near-term prices behave differently than longer-at prices, it can tell you whether immediate demand is tight or loose. In tight physical conditions, near-term pricing can stay supported even if paper gets hit. In loose conditions, the whole curve can sag. Third, do premiums in the real world stay elevated? If coin shops, refiners, and wholesalers keep charging up for actual metal, that's a signal the physical side is not mirroring the paper panic. If premiums compress hard, it can mean the stress is actually broad. And pay attention to when it happened, not just what happened. The nastiest moves in commodities often begin when liquidity is thin. When fewer real buyers are sitting on the bid and a burst of selling can slice through multiple levels. Once those levels break, stop orders trigger. Trading systems flip from hold to reduce and the move starts feeding on itself. That's why you can see a first leg in the overnight session, a pause, and then a second leg when the next major session opens and order books come online. Now, if you want a macro lens that doesn't require a shadowy villain, watch the dollar and watch real rates during the same window. When the dollar catches a bid and real rates firm up, metals can get hit, even if the long-term case is still intact. It's not that gold failed, it's that the pricing math changed at the same moment. From recent market updates, you can see how quickly expectations around rate cuts, inflation persistence, and growth scares rotate. And those rotations can move metals faster than most people expect. Also, don't ignore the big volatility target portfolios. There are massive strategies that rebalance based on risk budgets. When volatility spikes, those portfolios mechanically reduce exposure to anything that's moving too much. That can mean selling gold alongside stocks, selling silver alongside industrial commodities, selling whatever is lighting up the volatility meter because their mandate is to control risk, not to win an argument on the internet. That's one reason safe havens sometimes drop right when you expect protection. And here's a sneaky detail. After a strong run, a lot of traders are sitting on profits with tight trailing stops. When price cracks a widely watched level, those stops get triggered in bulk. That selling can look intentional, but it's often just crowded positioning getting flushed. The next batch of positioning data and the changes in dealer hedges will tell us whether this was mostly longs being forced out, shorts pressing, or both at the same time, and that matters for the next rally attempt. Now, based on recent market updates and recently published numbers in the broader commodity space, volatility has been creeping into more places than just metals. You've seen sharp moves in energy, in certain industrial inputs, and in currency pairs that feed into commodities pricing. When risk moves like that, metal traders don't live in a bubble. They risk across the board. Here's where I get personal for a second. If you're new to this space, days like this can feel like betrayal. You hear safe haven, you hear store of value, and then you watch silver drop like a meme stock. That whiplash is why people quit at the worst time. the market turns investing into emotional injury. So I want you to separate two things. One, the long-term case for owning hard assets as insurance against currency debasement, policy mistakes, and systemic fragility. Two, the short-term behavior of a leveraged paper price, which is driven by positioning, liquidity, and risk management. Those are not the same thing. And if you treat them as the same thing, you're going to make decisions that don't match your goals. Now let's address the elephant in the room. Is this manipulation? Here's the cleanest answer I can give. The metals markets are heavily financialized. A small number of large participants can move paper price more than the average person expects. That's real. But manipulation, as a word, can also become a mental crutch because it lets you outsource responsibility. If you label every down move manipulation, you never build a strategy that survives volatility. You just build a belief system. So instead of debating the word, let's talk about behavior that matters. When a move is this sharp, it usually involves one or more of these forces. Big funds cutting risk because trend models flipped. Dealers unwinding option hedges after a key date. Margin calls forcing liquidation. Liquidity pockets thinning out at the wrong moment. And yes, sometimes large entities pushing price into zones that benefit their positioning. Those forces can stack. That's when you get the waterfall. Now, I'm going to tell you something that sounds obvious, but most people don't act like it's true. The market doesn't owe you a straight line. Even in the biggest historical runs for gold, there were gut check corrections. Even in silver's most iconic spikes, there were violent reversals. If you zoom out, you see the story. If you zoom in, you see the pain. And that brings me back to the idea of stairs stepping, because that concept is not just for retail dollar cost averaging. It's also how big books manage exposure. They scale in, they scale out, they hedge, they offset. They don't bet the farm on one directional move and then cry on the timeline when it doesn't work. A lot of people think the big players must be dumb because they're allegedly short metals forever. That's not how professional books operate. A professional book can be structurally short on one side while long elsewhere, or short in one tenor while long in another. They can make money on volatility itself, they can make money on spreads, they can make money on the crowd being emotional. So if you're sitting there thinking, how could anyone survive being short into a big rally? The answer is they're not just one position, they're a web of positions. Now let's talk about the synchronized move across regions again, because this is where a lot of myths get born. People see the same pattern on different screens and assume coordination. But there's another mechanism that can create the same visual arbitrage. If one market trades lower, algorithms buy it and sell the higher market until the spread compresses. That creates a near identical path, so the existence of similarity doesn't prove intent, but it does highlight the dominance of the paper layer and the speed of cross-market linkages. If you thought one region was totally independent and would set price in a way that could never be dragged by Western paper flows, today is a reminder that capital moves fast and pricing signals get transmitted instantly. And here's the cliffhanger. If physical demand really is as strong as people believe, the next days will show it. You'll see it in delivery behavior. You'll see it in how quickly dips are absorbed. You'll see it in how quickly the market stops acting like it's in a forced unwind. Now let me ask you a direct question. When silver drops this hard, do you see an opportunity or do you see a warning? There's no shame in either answer, but you need to be honest about your time horizon. If you're trading, this is danger. If you're accumulating for the long run and you have a plan, this can be a gift. If you're over-leveraged, it's a nightmare. And by the way, if you're successful, share your success story in the comments so others can stay motivated. I'm serious. People need to see real examples of discipline paying off, not just highlight reels. Now, let's do something most channels won't do on a day like this. Let's talk about what could happen next without pretending we have a crystal ball. Scenario 1, the market stabilizes quickly and we get a sharp snapback. That often happens after liquidation because sellers were forced, not voluntary. When the forced sellers are done, price rebounds like it was underwater. Scenario 2, we get a bounce and then another leg lower. That happens when the first leg breaks sentiment and then real money steps back, letting price drift down as buyers wait. Scenario 3, we churn sideways, confusing everyone. That happens when both sides are exhausted and the market needs time to rebuild positioning. Which scenario is most likely? It depends on two things, liquidity and narrative. Liquidity tells you whether buyers can actually absorb the flow without slippage. Narrative tells you whether people feel safe stepping in. And right now, narrative is about to get messy because the same voices that screamed up only are going to either disappear, blame dark forces, or suddenly become long-term investors the moment their short-term calls fail. That's why I keep telling you, watch behavior, not bravado. Now, I also want to address the idea that this proves the system still controls price because that's partially true, but it can also be misleading. Control is not absolute. It's conditional. It depends on liquidity, it depends on collateral, it depends on willingness to take the other side. Big players can move price when the market is thin and leveraged, but they can't print physical metal out of thin air. They can't change geology. They can't change industrial demand with a button. So the real question isn't who controls price today. The real question is what happens when paper price diverges too far from physical reality for too long. And that's where the long-term bull case lives. Silver isn't just a shiny rock people argue about online. It's an industrial input. It's used in electronics, solar, medical applications, and a stack of other processes. Gold isn't just jewelry and vibes. It's a reserve asset, a hedge, and in some parts of the world, it's treated like money, even when people pretend it's not. When policymakers run deficits, when currencies get diluted, when confidence gets shaky, gold tends to remind people it exists. But the reminder isn't always a straight line. Now, I promised you I'd talk about the insider wash possibility too, so let's hit it. Could a large participant have pushed price down intentionally to hit certain option levels, trigger stops, and create a cheaper reload zone? Yes, that's possible. Markets are full of participants who play that game. If you can push price through areas where you know liquidity is weak and stops are stacked, you can create a cascade that does your work for you. But here's the skeptical alternative. You don't need a mastermind when the market is already overloaded with leverage. Sometimes the crowd builds the tower and then all it takes is a gust of wind. So my conclusion is this. Whether it was intentional or mechanical, the outcome for you is the same. If you don't manage risk and you don't control your emotions, the market will control you. Now let's talk about the retail experience because this is where people get hurt. If you own physical metal with no leverage, your risk is mostly time and opportunity cost. You can hold through volatility. If you own paper products that track metals, your risk includes tracking errors, liquidity events, and sometimes weird pricing dislocations. If you trade options or leverage products, your risk includes being right and still losing because timing is wrong. So if you're a newer viewer and you're thinking, how do I avoid getting wrecked? I'll give you a simple framework. First, decide your lane. Are you an accumulator, an investor, or a trader? Don't mix lanes without acknowledging the risk. Second, if you're trading, size down. The market doesn't care about your confidence. It cares about your ability to stay solvent. Third, if you're accumulating, build a plan with rules, not vibes, rules. When you buy, how much you buy, and under what conditions you pause. Fourth, diversify your information diet. If every voice you listen to agrees with you, you're not informed, you're entertained. Now, I also need to talk about the role of online hype because it matters more than people want to admit. A lot of folks believe that once metals reach certain round numbers, the system would break, someone would default, and we'd see price rocket without resistance. That's a seductive story. It's also a dangerous one because it trains people to ignore the mechanics that can smash price even in a bullish environment. And it's not just metals. You see it in stocks, in crypto, in currencies, in any market where narratives travel faster than risk management. So here's my warning. If someone is promising you that a specific price level guarantees a specific outcome, treat that like a red flag. Because markets don't move on guarantees, they move on flows. Now here's another retention point because I'm about to say something that could save you months of frustration. Don't confuse being right with getting paid. You can be right that currencies are being diluted and still lose money if you buy a leverage product at the wrong time. You can be right that silver is strategically important and still get smoked if you chase after a parabolic spike. You can be right about the destination and wrong about the road. And speaking of the road, let's look at what happens after major one-day shocks historically. When you get a single-day move that represents multiple months of normal volatility, the market often needs time to digest. That digestion can look like sideways chop, lower highs, or slow rebuilding. In other words, the bounce might not be immediate. That's why I'm telling you the next few sessions are going to be incredibly revealing. If buyers step in with conviction, you'll see it. If they don't, you'll see that too. Now, quick housekeeping because a lot of you ask where you can follow the extra stuff I share when things move fast. The description has bonus links, including a premium WhatsApp channel link and a channel membership join link. The most dangerous moment after a crash is the moment right after the first bounce because that's when people convince themselves the worst is over and they load up again and then the market does the second leg. If you've ever felt like price waited until you bought to drop again, it's not personal, it's just how liquidity works. The first bounce brings back the hopeful buyers. If there's still supply above, that hope gets used as exit liquidity. So what do you watch? You watch how price behaves around prior support levels. If support becomes resistance, that's a warning. You watch whether the bounce is on real participation or just thin air. You watch whether volatility calms down or keeps expanding. Now here's something else that's been quietly building that the competitor-style commentary often ignores. The broader macro backdrop. Even without naming sources, I can tell you what the public data has been screaming for a while. Government debt loads have been heavy, deficits have been persistent, and central banks globally have been playing a balancing act between inflation pressure and growth weakness. That creates whiplash in real yields and in the dollar, and those two variables can smack metals around in the short run. Based on the latest publicly available filings from large funds and the way positioning tends to rotate, it's also common to see big reallocations around month-end and quarter-end windows. Those calendar effects can amplify moves when liquidity is already thin. So if you're looking for a clean villain, you might miss the calendar. If you're looking for a clean calendar explanation, you might miss the positioning. Again, it's usually a mix. Now I want to address one more point I've seen people repeat. If the physical market is tight, paper price can't fall. That's not true in the short run. Paper price can fall even in tight physical conditions because paper can be sold in size instantly, while physical demand absorbs more slowly. Physical buyers can be patient. They can wait for confirmation. They can wait for premiums. Paper sellers don't wait. They press. But if physical tightness is real and persistent, it can show up later as a floor, as a faster rebound, or as persistent premium strength. That's why I keep saying don't judge the long-term story from a single day. Now let's talk about psychology, because this is where the market makes its money. The market loves to create a storyline where you feel foolish either way. If you bought before the drop, you feel foolish. If you didn't buy and it rebounds, you feel foolish. That emotional trap pushes people into impulsive trades. And impulsive trades are usually bad trades. So here's a better approach. Write down your plan while you're calm and follow it while you're not. If your plan says you accumulate when price falls by certain increments, then execute that plan with sizing you can live with. If your plan says you wait for stabilization, then wait. If your plan says you don't use leverage, then don't let a fast rebound tempt you into leverage. Because the market's next trick is going to be speed. Either speed up or speed down. And speed is what kills people who don't have rules. Now let me throw in a question that I think will spark a useful comment section. Do you think the social media hype around metals has helped the average person or hurt the average person? Because I've watched both. I've watched hype bring new people in who then learn to save and build discipline. And I've watched hype turn people into gamblers who get crushed and then swear off the entire asset class. So tell me your experience. And again, if you're successful, share your success story in the comments so others can stay motivated. A calm voice in a storm can change someone's whole trajectory. Now, I'm going to wrap this up with the most important takeaway, and it's not going to be the feel-good version. A day like this is a reminder that metals are not just a belief. They are a market, and markets have structure. They have leverage. They have forced flows. They have games around key dates. They have big players who can survive volatility because they're diversified across instruments. That doesn't mean metals are worthless. It means you have to respect the arena you're in. If your goal is long-term protection, focus on ownership, not price ticks. If your goal is trading gains, focus on risk, not predictions. If your goal is both, separate your accounts, separate your sizing, and separate your mindset. And one last thing, don't let anonymous hype merchants drive your decisions. If someone never shows accountability, never admits uncertainty, and only posts when they look right, they're selling you a feeling, not a framework. All right, take a breath. Don't let one day rewrite your whole thesis, but also don't pretend it didn't teach you something. Drop your thoughts below. Was this mostly mechanical liquidation, or do you think big players pushed it into a flush on purpose? And what are you doing next? Holding, buying, or waiting? Protect your capital and your peace. And as always, none of this is financial advice. I'm sharing market commentary for education and general information only. And I could be wrong. Make your own decisions. Double-check your risk. And if you're not sure, talk to a qualified professional who understands your situation.